For our purchases and transportation costs, we have two different kinds of shipping terms. We have FOB shipping point and FOB destination. The FOB stands for a term called free on board. What really you need to know is whether it is shipping point or destination. Why this is important is because this talks about the transfer of ownership, which means who is responsible for those goods once they are placed on a truck or airplane or train for transport. Why this becomes important is because if goods are damaged in transport, the person responsible for the damage is whoever owns them at the time of transport. So FOB shipping point terms means the owner takes ownership at the time that a good is placed on a truck for purchase. So that means if the truck gets in an accident, there are icy roads and the semi crashes, it is the person buying it who is responsible for the fact that that truck crashed, even though that stuff wasn't in our store yet. For destination, goods in transit are owned by the seller. So goods don't transfer ownership until they are physically placed in the hands of the buyer. As a buyer, we want destination ownership. As a seller, we want shipping point ownership. We want to transfer that ownership as soon as possible so that we're not liable for goods in transit. But as a buyer, we don't want to be financially responsible for those goods until they have been handed to us. So there are two different accounting methods depending on whether we're shipping point or destination. If we're shipping point, we add shipping costs to our inventory. So we merchandise inventory and debit cash or accounts payable, however we pay for it. If shipping costs are destination, then that is a delivery expense for getting them to us. So it's very important to understand whether the ownership is shipping point or destination because they have different accounting treatments. So we're going to look at this example. We purchase merchandise on terms of FOB shipping point. The transportation charge is $75. If we have FOB shipping point, then we inventory the cost of shipping. That becomes a cost of having inventory. Merchandise inventory is debited for $75 and we credit cash for $75 to pay for those. Now we're going to look at recording sales of merchandise. So all of the previous amounts were just getting merchandise in for us to sell. Now we're going to sell merchandise to customers. So when we're selling merchandise to customers, we develop an expense called cost of goods sold. That cost of goods sold is the amount of our inventory that was sold during the accounting period. Our sale price minus our cost of goods sold gives us our total gross profit. When we sell merchandise, we have a two-part journal entry. The first part of the journal entry is to record the revenue received from the customer. The second part is to recognize the cost of merchandise sold. So here we sell $1,000 of merchandise on credit. The merchandise cost us $300. So our sales price is $100. Our merchandise price was $300. That gives us a profit of $700 on that merchandise. To record the sale, we have a debit to accounts receivable for $1,000 and a credit to sales for $1,000. That records the sale of inventory. To record the cost of goods sold, we have a debit to cost of goods sold for $300, and we need to remove that inventory from our inventory account. So a credit to inventory for $300. We can also offer sales discounts to customers, just like our suppliers offered to us, in order to encourage them to pay us faster. The discount period and credit terms are very similar to the ones that we had from our suppliers. So we complete that $1,000 sale, as we saw before, and we have terms of 210 and 45. So we first have the record of our sale. We record the revenues and we record the cost of goods sold. Then, if the buyer pays within the discount period, we record a sales discount of that 2%. We receive cash of $980 and we credit our accounts receivable for the full amount of the sale. If they pay after the discount period, they have not taken their discount and they pay us cash for the entire $1,000. We also have sales returns and allowances. So sales returns are merchandise that customers return to us after a sale. Sales allowances are reductions in the selling price for merchandise sold to customers. So we've offered them a discount of some kind. If a customer returns merchandise, we would have a sales returns and allowances of $15 and we would return them cash. If those returned goods are not defective, we would add them back into our merchandise inventory. If they are defective, we would record that we had a loss from defective merchandise. For allowances, here we have $40 of the merchandise we sold is defective, but the buyer decides to keep it because we offered to return part of their money. We would then record a $10 sales returns and allowances, and that we reduced our cash because we gave them back $10. Once we're at the end of an accounting period, we have adjustments for our sales revenues. So remember that revenues and expenses are closed at the end of every accounting period so that we can prepare for the sales and revenues and expenses of the next accounting period. That matches revenue recognition and the matching principle. So when we're closing accounts for the accounting period for a merchandising company, we need to close our cost of goods sold. We've added this income statement account of cost of goods sold. So the cost of goods sold account also gets closed. Another adjusting entry that merchandisers have is to record for shrinkage. Shrinkage is the loss of merchandise. We can lose it for a variety of reasons. It could be stolen, it could be damaged, but this is merchandise that when we do a physical count of our inventory, the inventory that we have on hand does not match the amount of inventory that we have in our computer. And so we have to account for a loss of that merchandise. We debit cost of goods sold and we credit merchandise inventory for the amount of that. Okay. We also have new revenue recognition rules in accounting that require reporting of sales at net amount expected. That means we would adjust entries for expected sales discounts, expected revenue returns and allowances, and expected returns and allowances for the cost side, the cost of goods amount. And how we predict what those amounts are based on our historical information. For example, if we're a retailer, we know that we have a high level of returns in the month of January. So we might be able to predict what our typical January returns are based on our experience of having returns in the month of January. Our closing entries, we see we have extra accounts. So our first closing entry is sales to income summary. That's the same as a service organization. But then we need to close our expense accounts. And you see that we've added sales discounts, sales returns and allowances, and cost of goods sold. Those all have to be closed for the next accounting period. All of the other components of the closing entries are very similar to what we looked at in Chapter 3.